Oh boy. Episode 3. What's going on, guys? Thank you, Chef. This will probably be one of the hardest videos to understand, and just concepts in general from ICT, liquidity, understanding it. It's a pain in the ass. Without further ado, today's video we're understanding liquidity and institutional order flow. Whoa, big words. Right. What is liquidity? Liquidity essentially is a pool of stop orders. Remember what stop orders were? It's stop losses in general cases. Remember in the last video, I was showing you where our buy stops and sell stops will be. Meaning if we're in a long, we're going to be having sell stops below price, protecting us from price going lower and us being more in drawdown and more negative on the day. And vice versa, shorts, we're going to be having buy stops above our price. So if price goes through it, we stopped out at this price level, and so we're not taking the negatives as price is going up. And where liquidity lies is above prominent highs and lows, right? I showed you an example. Everyone is always trading something, and there's going to be liquidity everywhere, but where they lie are above highs and lows. And in episode 4, we're going to be talking about which specific highs and lows. That's going to be the very, very important concepts taught there. But understand, liquidity doesn't lie in random areas, doesn't lie within bodies of the candlesticks. It lies above the highs and lows. Lies below. Above and below, highs and lows. So we have pools, we have so many willing traders to have stops there. And what does the algorithm ultimately want to do? It ultimately targets those highs and lows. And the algorithm is presented that way because majority of retail traders, I'm a retail trader. If you're watching this, you're a retail trader. The majority of retail concepts, supply and demand, support and resistance, majority of traders are trading that. Therefore, the algorithm can predict those concepts, which highs and lows specifically they use, and our algorithm ultimately targets them. Right, and we're going to be saying that later in the video. And like any other ICT concept, liquidity is fractal. Remember how I show you highs and lows on the 1 minute and then on the hourly. Again, same for liquidity. We have players who are swing traders, and we have scalpers who are intraday liquidity traders, meaning they're not targeting liquidity from previous day. They're targeting liquidity from maybe an hour ago, maybe 2 hours ago, maybe a previous session. Sessions we're going to be talking about in another video. So we can have liquidity resting in a 1 minute time frame. We can have liquidity lying on the hourly, on the daily. It doesn't matter. You just gotta figure out what kind of trader do I want to be. If I want to be a scalper, all I need is intraday liquidity. How does liquidity look like on the charts? Let's take a look. Here's our example. Here's our basic example. Your price make a higher high, lower low, higher high. Over here, generally speaking, not going into the specific price action, if we create a low and then displace from it, we're going to be building sell side liquidity. And we can mark it by just saying SSL, sell side liquidity. On the other hand, we can have a high and we can trend downwards, and we're ultimately going to be building up buy side liquidity there. And realize how I also showed these two, this high here and this low here being taken out, because there's still highs being taken out, but it doesn't mean that's the objective of either the buy program or the sell program. We can have highs and lows being taken out, but that not be the target. And over here we have the example on the charts. Right, we have this high over here taken out, and we ultimately create this low over here where sell side liquidity is resting. Meaning, what does that mean? We see market trending, and what does retail want to do? They want to buy. They want to follow that momentum. Everyone has their ways of trading. Everyone has their confluences, their reasons for entering. But just through bullish trends, people are going to enter. What does that mean? That means they enter somewhere within here. Fuck. But they have stop loss ultimately below here. And the real liquidity is lying all this whole price range, not just at this price level, all the way under here. The other way around, we have traders who see markets slowly start to trend down, and then we start to go down here. Now we have sellers with buy stops resting above here, even resting above this high. Those are relative equal highs. Episode 4, don't worry. And we had this low being taken out as consequence. But realized we didn't want to stop there. How is liquidity used by institutions? Right, aka smart money. We know that the algorithm wants to target pools of liquidity, but why? And we're going to understand this now. Smart money uses pools of liquidity to fill large orders without moving the price with their selling/buying power. So let's take buy side liquidity as the example right now. Whoops. If smart money wants to short, meaning they want to put sell orders in the market, without pools of liquidity, they're actually just going to crash the market with their selling power, because they're going to fill so many orders, the price is going to go down and down, and they're selling at a cheaper and cheaper price. You don't want to be doing that if you're an institution. So what do institutions do? They understand algorithmic price delivery. So what they do, they sell where the retail traders are putting their buy stops. And where is that? Above highs. And again, episode 4, we're going to be learning at exactly which highs. So whenever we have price go into these highs, these prominent highs where buy side liquidity is resting, smart money is shorting there because they're able to fill their large orders. And this is not only on the MNQ, on the ES, and the YN. This is on every single financial asset there is. It's not only exclusive to a certain set of assets. And for the downside, let's say market wants to buy. Sorry, institutions want to buy. They're not going to buy at a random point or just market order like you do, because they're going to crash the market, make price go higher from their buying power. Because the more they buy, the less participants are at that level. And there's going to be at higher levels of market participants willing to do that trade of buying and selling. So they're going to be buying at a more expensive price. That's not strategical. So what they do is they go to liquidities where they can execute large orders, not little by little per price point, where there's large orders, right? They can execute all their orders there, and then price would reverse. Why? Because algorithms always seeking two things: imbalances and liquidity. Imbalances we're going to talk about, not in this video. The liquidity, once it takes sell side, which is where market is longing, it's going to want to target what? There's only one other type of liquidity, which is buy side liquidity. Okay, I had to cut the video short, so see I'm wearing a different shirt. It's daytime, but let's get on the video. So how do we use liquidity, right? Essentially, we want to be like the institutions of smart money who are taking liquidity, right? We don't want to be the liquidity. We want to become the liquidity hunters. Like institutions, we want to target liquidity. Why? Because at liquidity, there's reversals, and that's where TPs will get hit. And that then price becomes more uncertain, could accumulate, etc. And we use liquidity for two reasons. Like I said, reversals, and two, as key levels or targets. Meaning, if a higher time frame liquidity, for example, has not been taken, we would sit in our hands and not do anything. We can use liquidity not only to plot our targets, our take profits, but also to wait for price action. Because if we're trying to enter while our targets are not being hit, let's say for a potential reversal, then we're just gambling. We're going to lose our money. And our chances of taking a trade or winning the trade is much less. Without further ado, let's look at some of the examples on how we can use liquidity. Now, this is a very basic example and very ideal scenario, and its charts are not always going to present you a certain pattern or structure that you want. So we're always going to have to adapt and do the best we can with what we have. And we're going to do that through risk management, through experience, right? But this is just a general example. So over here we have these highs made, and we can see market is in a sell program. It's going down. And let's say once you hit down here, we hit our target. It can either be an old low or a higher time frame imbalance. PD array, episode 4. No, that's going to be different episodes. Never mind. What we can expect, right, is once we hit a daily or a higher time frame target, like an old low, we can generally expect a reversal. And somewhere within here, we can have confirmations of entries here. We can target this high, this high, this high, or this high. Oops. And that's really how we can use liquidity. And in my opinion, the only valid way is we wait for our targets to be hit or a key reversal area, like an old low, because once we took liquidity here, what's the algorithm want to do? It's going to want to target the opposite liquidity pool, because we suspect that once you take this low, that is a draw on liquidity. That meaning the sell program is done, and now market is turning it into a buy program. And what is it going to do? It's going to target these highs, this high, and this high. And again, this is an ideal scenario. You know, market's not always going to show this type of market structure. Ideally, we want it to, but this is what we're trying to do. If we're trying to long it here, we're trying to buy somewhere here and target one of these highs. Stop loss below here. And this is an example here where we have resting highs here and liquidity above this whole area. And after price runs down, takes out this low, you can kind of see it's a little bit smaller. Goes to tap into a fair value gap here. And what does price do? We get moving up. Take out this liquidity here, here, and there. So from sell program to a smart money reversal into a buy program. This is a market maker buy model, but we're going to get into that into later videos. But we can see how market is deliberately targeting liquidity above here. Let's go to a sell program example. So over here, we have a buy program, right? Price is going up. And once we hit a higher time frame objective, like old highs, specifically on the higher time frame, we can expect that to be the draw on liquidity. Meaning, once price went from here all the way to here, we can expect or we can anticipate price to reverse. And we wait for confirmation, and keep doing this. And somewhere within here, we want to enter. And we're going to be discussing that in later episodes. Imbalances, PD arrays, OTE, order blocks, IFEGs, whatever. And we want to be targeting these lows over here, because why? There's liquidity. And when we take out liquidity, we have potentials always for reversal. So we can have a run like this, but we can just completely reverse after. So it's important to understand what type of trader you want to be. Do you want to be taking all of this liquidity, right, and be done for the week? With prop firms, you can't really do that, but or do you want to be a type of guy that's in and out, zero stress, high probability? Regardless, in hindsight, this is the ideal this is the ideal pattern. where price transitions from a buy program to a sell program and takes out all of our liquidity. And again, we want to be on these moves, capitalizing that we are in a sell program and that we are taking sell side liquidity. We want to be like the institutions. We don't want to be the prey of the institutions, because retail views as these areas as support. Retail puts their stop here because they see this level as a point that market shouldn't break. Vice versa in this example. If retail is shorting here, they see these points as support. So naturally, they're going to put stop losses here, here, and there. And just using that knowledge every time, knowing that there's so many players in the market, especially retail, that have their stops here, it's going to be very easy for you to understand liquidity. Understand that algorithm is actively seeking out these people, and even you sometimes. All right, and here we have an example. We have these lows here, all these lows, and got taken out all within one swing. Right, we have a buy program, and again, remember how I said it's not always going to be an ideal buy program, meaning it's not always just going to go directly up, in a staircase pattern. Market is always going to fluctuate. Go up. You can even consider this low over here that's been taken out, because that's within this whole buy program, and there is liquidity here. I just wanted to point out this whole section. Market takes it out, and we even reverse after. You see that? We take out all of this liquidity, and this final low is a draw. The market starts to reverse. So from here, we can even plot the first example where we created a sell program and turned into a buy program. This is ICT's market maker buy model, market maker sell model. And I think maybe I'll go over it in another episode in this mentorship, but just for now, understand these basic ways how we can target liquidity. Now, not every single high and low is valid for reversal, or on the contrary, continuation. Like I said, if just because we took out this low, it doesn't mean we're going to reverse off there, right? Again, this is just a very plain example and ideal scenario. What we're going to talk about in episode 4 is understanding pretty much where's the draw for the buy program and where's the draw for the sell program. That's what we really want to know, because we don't want to be reversing here because market is still in a sell program. Where is the draw on liquidity, the DOL? We'll be using that a lot in episode 4. And I'm gonna go on TradingView right now and show some more live examples for you guys to understand liquidity. Right. So right here, we're on the MNQ 100 micro E-mini NASDAQ 100 futures contract, September. And right here, I can already plot out liquidity. I want to show this is on the 1 minute. And again, like all ICT concepts, they're all fractal. You can plot out liquidity on the 1 minute, 5 minute, 50 minute, 1 hour, 30 minute, on the daily. It is all valid. So here's a high, right? It's a higher high. Now we have market trending down. There's liquidity there. There's people who shorted it for whatever reason, and they have stop losses here. And wherever their targets are, when they're in here, they never pull out of the market. For the ones that did pull out somewhere within here, they're smart. But for the people that didn't pull out of the market and had stops here, they viewed this as a point of resistance, retail, and retail concepts specifically that ICT does not teach. There are stops above this high, right over here. Specifically, there's going to be buy stops. And look at what price does. Price has just got a little bit over it. It goes up, and we accumulate. And accumulation, we're also going to be talking about in separate videos. I think maybe I'll talk about it in episode 4. We'll see. But market goes into this liquidity, And we have an accumulation for shorts now. Because what did the market do? It took out all this liquidity here. All the players that were thinking, okay, we're going to reverse now, just got absorbed. They all just got their stop losses hit. And now understand from an institutional view. Institutions, they're waiting for price to get to this point so they can execute sell orders here. Because then we have willing participants who have a large amount of buy orders in here. So they're able to sell a large amount without lowering the price and crashing the market. And then look at the value reaction we have after. 1 minute. Now I'll show you the 50-minute, an hourly, even on the daily. So that reaction we have there. And there is a setup. That could be a setup if you're trading on the 1 minute, right? I'm not going to go into what time frame we're in, what's happening, news. I just want you to understand just the liquidity itself. And that I'm just going to use the liquidity line as just the point of entry. We took it. And then finally, we're displacing. Close back over it. Short here. Stop loss here. Target this fair value gap. And don't worry about the terminology. Just understand what you can do. Understand liquidity. Forget what price is doing. Look at the reaction. We're going to figure out how you can actually capitalize on these moves and how you can confirm them. But just look at the reaction. Look at what happens after we take this high. All right, let's show more examples. I can even show you here. And I'm doing this all live, but none of it's scripted, because I want to show you how confident I am in these and how much I understand liquidity. Because once you understand it, it's very simple. I promise you. You just have to really, in your own time, you have to really plot this out and look for the reactions. Right here, we have lows created here. It's not exactly part of a sell program. You can see it's the market structure. It's not going here. You see how here price isn't moving anywhere, it's moving sideways. That's an accumulation stage. Regardless, look what price does. This whole 3-minute candles here takes out this liquidity. And then what do we have after that? After that, we have a reversal. Price immediately goes up. Fair value gap. This is actually very, I wish I was trading this today. This is today. And again, where can we target? Could target this high. Target that high. Could target this high. Look at the reaction. We took out sell side. And here I'm gonna just use, actually that's okay. So anything below here, get orange. Anything below here, this is where we want to have our entries. Not always, I won't say that, but this is where institutions are buying. This is where there's willing sell participants. I'll draw this out like this. Here's the pool of liquidity. Here is where everyone is longing. They long here, and their stop losses all here. Who cares about their targets? Because they're still in the trade. If they hit their targets, they wouldn't have their stop loss here, but majority of people have stop losses there. So they're losing money there. And institutions and smart money, they're willingly buying them or selling. No, they're buying them. Again, why they wanted to buy in liquidity, so they don't crash the markets. Otherwise, we would have crazy markets. They're just buying or selling, whatever. They need to be buying here. So there's just another example. And again, maybe I'm cherry picking. You're thinking, oh, I'm cherry picking. Who is this ICT guy? And I'll say right now, this is a beginner's course. Once you finish this playlist, once you understand enough about the very basics of trading, liquidity, fair value gaps, order blocks, I highly recommend to watch ICT himself. When I started ICT, I didn't watch it myself. It was a good friend I met online who told me, yeah, you gotta start watching ICT. And I was watching TGR and just some random other people, but you really have to watch his content. He has helped me in my trading so much. And I recommend starting the 2022 ICT mentorship. That's what I recommend. That was very fundamental to my understanding as a trader. And I watched that way too late. So after you've done this playlist, or as you're on this playlist, I recommend watching 2022 ICT. It was an amazing playlist. And everyone says the same thing. Anyways, I showed you two examples here. On the buy side, how over here we use it to plot a long, and then inversely we use it to plot a short. Now, we didn't necessarily target these lows over here, right? You see reversal. And I think I targeted this fair value gap over here. But it's however you want to trade. Whatever you're comfortable with, whatever you're looking for. It doesn't matter. It really doesn't. You gotta do what you really want. You wanna trade how you wanna trade. It's not about trading how I trade. It's about understanding the markets, understanding what ICT talks about, and then you build your own model. You build how you want to trade. Do you want to be in trades for 2 hours? Do you want to be in and out in 10 minutes? Do you want to be on the 15-second time frame, just scalping? Right, let's go on the 50-minute. Show some higher time frame examples. Okay, let's see one right here. This is a sell program over here. What to do? Market within an hour and 30 minutes, dumped here. Get red. And everyone is going to want to be catching this momentum right here because we're going down. Retail traders they see lows being broken on the lower time frame. They think it's a breakout. So naturally, they're shorting this and stops are here. Market then reverses, turns into a buy program. And I'm going to leave this, but I'm going to show you something with that later. I'm going to be proving how liquidity is fractal. But for now, we have this. Whoops. We have this high over here. Thicker. And look, what did market do over here? We took it out. Look what market did right after. Back into a sub program. Now, we didn't go all the way down to target this low again, but we had a reaction. If you want to be profitable, that's all you need. Let's go in the 1 minute time frame. That was 15 minute. So what can you do? We know that this high was taken. We wait for confirmation. The price is reversing. Got ticked into here. Stop loss here. Target. This low will be an hour and I'd say obviously. But again, you don't need all of this to make money. How would this look like if you sold this? If you put in 5 contracts here, stop loss there, TP at this low, Ignore the negative and the plus. This would be your take profit. You'd be taking $400 from the market here, and you're risking 200 for it. And you're in this for how long? 50 minutes. People don't make this in a day. This is real opportunity. This is real opportunity. This is what got me hooked to trading. You can actually be doing this. And the trading itself is not hard. Once you understand the concepts, that actually becomes the easy part. It's the psychology and the mindset and the control of emotions that really become the hard part. And people can't tame that part of themselves, so they quit. But I'm showing you this. I'm showing you how price is reacting up here. And I promise you, the more I'm going to be teaching ICT, the more you're going to be convinced that what I'm telling you is true. Now, I told you I want to be marking out. I don't want to delete this because I'm pretty sure on the daily time frame, it's important. It is. Or on the daily time frame, that means each candle here is showing price action within that entire day. We marked out this daily low and we took it out Thursday, yesterday. What do we do? Dropping down to 15-minute time frame. Let's go back there. We wicked it here. And then we really went below this level, taking out all the liquidity. This is called a stop raid. And we don't just go a little bit below liquidity and wick it. We really go below, close over it, and reverse. This whole area, this would be a smart money reversal. Now this is where institutions that are trading higher time frame, they're buying here. They're buying here. They're buying here. We're targeting liquidity. This high, eventually this high. But I just showed you how markets work from the daily, the 50-minute, down to the 1 minute, and how you can be profitable everywhere there. Because if you're an actual day trader, knowing that we took out this low, that took out the August 6th low, and we went way below it, this is a model itself. And again, I don't really teach this type of trading, like actual day trading, and hold a position for 7 hours, but see it play out. It's the same thing in lower time frame. It's no different. It's no different. And I'll show one more example before you end the video. I'll show it to sell side. Well, I showed it here, but I'll show you lower time frame. Let's see. And we're gonna go from 50-minute to 1 minute. Over here. We have liquidity here. Resting. Right, this whole, this whole price action here is a buy program. Once you took out this low, what did the market do? It prompted a reaction. Now let's go on the 1 minute time frame. We can see exactly where potential entry could be. That's around here. I took this trade. I took this trade actually. And because August has been a very sloppy month, it has been a pain to find a really good setup. But I took this trade along with my friends. We all took it. I actually did a trade recap on this. You can check it on my YouTube. But what did market do here? Market took out liquidity. Forget where your entries are. Forget where your take profits are. Price reacts. And all you have to do is just follow that reaction. You don't even really need to take this high. You just needed to be part of this whole buy program, right? Because you don't need, because look how much price moves. If you entered somewhere within here at this price, so that's where I entered. That's crazy money. And it'll be more fair. Let's say you're here. I got ticked out here. This is where I left the market. Stop loss was here. You just need confirmation that price wants to go the other way. And our main confluence, our main reason is always going to be liquidity. Above everything else is going to be liquidity. What did the higher time frame hit? The higher time frame hit a low in Asia session. Because that low is how long ago compared to 10 a.m., 10:30? 8 hours ago. We have pending stop orders there. South side liquidity. We have people who are in the market here. I promise you, maybe this is a little bit confusing to you. Maybe you say, oh, which high do I pick? Which low do I pick? And we're going to be discussing that on episode 4. All of you are going to understand which exact highs and lows to take. I really hope this was a good introduction to liquidity for you guys. Episode 4 is, again, going to cover all the important concepts for relative equal highs and lows, high resistance, low resistance highs and lows. And yeah, we're going to be talking about episode 4. If you have any questions about this video, do go into my Discord server. If you're a beginner, just ask away. I was once a beginner too. I don't understand this, so don't feel shame in asking questions. If you really truly have questions you don't understand, I'm always online. You can hit me up, either DM or in the questions forum. That's that. Thank you guys for watching. Like and subscribe if you like the video, and I'll see you in episode 4.